investment expert talks about why 30 to 40 crores is required for decent retirement. Welcome to Financial Fusion. Today we have an insightful discussion with an investment expert on why accumulating 30 to 40 crores is crucial for a comfortable retirement. Let's delve into the key factors and considerations that underline this financial milestone. Retirement planning begins with understanding the cost of living comfortably post-retirement. The figure of 30 to 40 crores reflects the need to sustain a desired lifestyle, accounting for inflation, healthcare costs, and unforeseen expenses. This amount provides a buffer against economic fluctuations and ensures financial stability throughout retirement years. Emphasizes the importance of long-term financial planning to achieve this goal. Building a retirement corpus of 30 to 40 crores requires strategic allocation across diversified investment vehicles. These may include equities for growth, bonds for stability, and real estate for income generation, tailored to individual risk tolerance and financial objectives. Diversification is key to mitigating risks and optimizing returns over time. By spreading investments across different asset classes and geographical regions, retirees can hedge against market volatility and maximize portfolio resilience. This approach not only protects capital, but also enhances wealth accumulation potential, aligning with retirement income needs. The expert highlights the impact of inflation on retirement savings. Over decades, inflation erodes purchasing power, necessitating a robust investment strategy to preserve and grow wealth effectively. Allocating assets that outpace inflation ensures retirees maintain their standard of living and sustain financial independence throughout retirement. Healthcare costs are another critical consideration in retirement planning. With increasing life expectancy, allocating funds for healthcare expenses becomes essential. The 30-40 crores target accounts for medical emergencies, long-term care, and quality healthcare services, safeguarding retirees' physical and financial well-being. Retirement income planning involves creating sustainable cash flows from investments. Advises on utilizing annuities, dividend-paying stocks, and rental income to supplement pension funds and Social Security benefits. This diversified income stream minimizes dependency on market fluctuations and supports a steady retirement lifestyle. Tax efficiency plays a pivotal role in preserving retirement savings. Recommends structuring investments to optimize tax benefits, such as utilizing tax-deferred accounts and capital gains strategies. This approach minimizes tax liabilities and maximizes after-tax returns, ensuring retirees retain more of their hard-earned savings. Finally, stresses the importance of periodic portfolio review and adjustments. Monitoring investments regularly allows retirees to adapt to changing market conditions, rebalance asset allocations, and capitalize on new opportunities. This proactive approach enhances financial resilience and maintains long-term investment objectives. In conclusion, achieving a retirement corpus of 30 to 40 crores requires disciplined financial planning, prudent investment strategies, and a proactive approach to wealth management. By aligning savings with retirement income needs, retirees can enjoy financial security, pursue personal aspirations, and navigate life's uncertainties with confidence. Thank you for joining us today for this insightful discussion on retirement planning. For more expert insights and strategies on achieving financial goals, subscribe to Financial Fusion and stay tuned for future updates.